Today we're looking at interest only. We're looking at how it works and whether or not interest only is the right option for you. And quickly, an interest only facility essentially means you never pay off the mortgage. So if we look at time on the bottom axis and a loan amount on the top, usually what happens is with the principal and interest repayment, over time, your mortgage will end to zero. Typically, that's over a 30-year term. And an interest-only facility essentially means you never pay off the home loan. So instead of this scenario where it's a principal and interest, and we can see that the $300,000 loan over 30 years is paid to nil, an interest-only facility means that you never pay your mortgage off. It's a straight line. So both now and if you have a 30-year interest-only period, you'll still owe $300,000. And the biggest difference is the actual repayment you'll make. On the screen in front of me, what you can see is that two different scenarios being played out in real life. So we've got a $650,000 mortgage over 30 years with an interest rate of 6%. The frequency of repayments are monthly. And what we can see is that the blue is essentially what the principal and interest repayment line looks like. And the dark blue is what the interest and only repayment period looks like. So what I've selected here is a 30-year interest only period. And throughout this period, all you'd have to pay for this scenario would be $3,250 per month. And think of this as a rental. That's a rent you're paying to keep the mortgage. So long as you're paying the rental, you'll actually not pay off the mortgage ever. Like renting, you'll never own the debt. The debt will always remain like a rental property, and that's what interest only is. However, if we go ahead and we put a 0-year interest only term, we can see that the repayment increases to $3,897 a month, and providing the interest rate doesn't change, your repayment will remain that for the duration of the period, so over the 30 years. And at the end of the 30-year period, you'll actually pay off the debt and own the property. And this is the biggest difference, with interest only allowing you to reduce your repayment to the absolute minimum compared to, say, a principal and interest, where you pay a little bit more, but over time you'll actually pay it off. So what are the pros and cons of an interest only facility, and why would you choose to go interest only? The first reason you do this is to preserve good and bad debt, and let me explain. So say you own a property and it's your home. Let's call this a $1 million property, and it's your principal place of residence. You've got $500,000 owing on this debt, and you've purchased an investment property for, say, $500,000 investment. And to keep the scenario simple, we're just going to say you put the deposit in, and you've got a $400,000 debt. Now, the first reason you might consider going interest only is to preserve good debt. In this case, good debt is actually your investment debt. And until your owner-occupied debt is paid off, which is bad debt, it's silly to try to put more towards your investment debt. And instead, what you can do is you can opt for an interest-only term on your investment debt, putting all your surplus monies available into your principal and interest or owner-occupied debt, really focusing on paying that off as quickly as you can. And once that's paid off, you can look to then divert funds towards your good debt. That's the debt that's tax deductible. And ultimately, investment debt allows tax deductions because of its very nature. And that's why it's considered good debt. So the first reason you look for an interest-only term is to preserve good debt and to put the additional monies you'd have available into bad debt, that's your own occupied debt, to pay it off as quickly as you can. The next reason is more strategic, because ultimately, if you're looking to build a portfolio, interest-only is an exceptional option. It's an excellent option, and I'll tell you why. So when you're building an investment portfolio, realistically, the thing that stops most people is the deposit, because ultimately the hard thing to buy more and more property comes down to the deposit you have. Now, in most cases, what people will do is that they'll buy a property for, say, $500,000, and they will wait for that property to appreciate in value. So say that goes up to $800,000. And once that's increased in value, we'll look to unlock equity that's available in the property. And that's one way to do it. Now, that works really well when the market's increasing. But what astute investors will look to do is they'll consider if the market isn't increasing, they will have an option B. And option B is using interest only to its full advantage. So in this case, you're paying the minimal deposit, but instead you're going to have an offset facility. And in this offset facility, it'll be an account where you're putting all your additional funds that are available into it and essentially building up a buffer. Over time, that buffer will increase, and essentially it's a savings account. Over time, that will increase, and as that increase, that can form a deposit towards your next property. So if your property doesn't appreciate, plan B is to use what's in your offset account and will allow you to fund the purchase of your next property. And the cool thing is that with an offset account, say you've got a $400,000 mortgage and you've got $50,000 in your offset account, you're only paying interest on the difference. So in this case, it'd be $350,000. You're getting all the benefits as if you're paying off the mortgage on a principal and interest repayment period, but it's allowing you to have a strategic outlook on where you're going, what you're doing, and more importantly, ensuring that when you're ready to purchase the next property, you're not hoping and praying that your properties increase in value, that you've got plan B. That yes, plan A would be ideal if the property price increases and you can leverage equity, but plan B is that you've got a saved deposit ready. And the main advantage of interest only is to preserve cash flow. So in most cases, if you're not an investor, the only other reason you may consider to go interest only is if you're planning to renovate the property and you want to hold as much capital and cash flow as you can to fund the renovations, or if you're planning to have a child and you're wanting to just to have a little bit more wiggle room. Remembering that if you have that offset facility set up, that it's essentially the same as paying principal and interest, providing you're disciplined with your approach, but it allows you to have the ability to take that money back and ensuring that that can go towards other things. So whether it's the renovation of a home or it's preparing for a little one to enter your family. Now, the issue with an interest-only facility is that you never pay off the debt, and it's something to be acutely aware of because in most cases, banks will allow you to have up to 5 years interest only, but after that period, your repayments are going to spike because your repayments will be based on a 25-year loan term, and this can be bill shock. So if you have chosen an interest-only facility, you really want to keep an eye on it because when you're getting closer to the deadline, when your interest-only facility is up, you'll actually have to reapply to get a new interest-only facility. That means the bank will have to reassess your application, looking at your income and your full financial situation to decide whether they can extend the facility or whether you'll have to go back onto the principal and interest repayment term. So something to keep in mind. And again, it's something to be aware of because in that interest only period, you're actually not paying off the debt. And if you're looking for a great mortgage broker here at Hunter Galloway, we can help. There's no fee for what we do and we service Australia-wide. So reach out and visit us at huntergalloway.com.au or call us on 1300 088 065. We'd love to help.